Welcome back. My next guest, he's got some fantastic takes on the market. And for one, I agree with a lot of what he has to say. There wasn't really anything on the bone when it comes to what the Fed had to say in yesterday's press conference. He mentions that the Fed used all of its bullets when it cut rates 75 basis points last year, when they really didn't need to. And again, I agree on that too. And think of it this way, right? The Fed cut rates 50 basis points last September. Suspiciously close to the election. I wonder, right? And stocks were near record highs. So he cut rates when stocks were at record highs. But fast forward to the last 6 weeks of a huge stock swoon, high volatility. Remember, stocks tanked and the Fed, they didn't even budge an inch. So it makes one wonder, doesn't it? Were the rate cuts even needed last year? Now, my next guest, he likes gold and has a decent position in it. And he also feels the same that I do about Scott Bessent, the Treasury Secretary. He's increasingly being rolled out as the face of the administration when it comes to handling a lot of these tariff deals. So I don't want to give away all of his secrets. Let's let him come on and tell us more about what he's got going on. Please welcome to the show, Mr. Eddie Ghabour. Eddie, thanks for coming on. I agree with a lot of what you had to say in your notes. I love the fact that I'll say it one more time because I'm sure the viewers are sick of me talking about it. But back in, I was in the pits in 1992 in London, where George Soros and another guy by Stanley Druckenmiller, they broke the Bank of England when the sterling was trying to stay within the European exchange rate mechanism. Now, you're probably too young to remember all that stuff, but I was in the middle of it. I had a huge short sterling options position on, and Soros and Druckenmiller, they ended up winning. I think it's the first time a hedge fund made $1 billion in a day. But they had a young acolyte in the office with them that was really pressing that trade and actually got George Soros to double down on it. And that guy's name was Scott Bessent. And I love the fact that we've got a guy that close to the president, or at least has the president's ear, because I wholeheartily believe that he's the one that got that 90-day stoppage, right? I think that he was on the plane with him and convinced him, and a few other things that I think have really kind of settled things down. And he also knows, hey, when you've got the markets doing what they're doing, equities screaming lower, the 10-year yield screaming higher, you got to be careful about having something break. And I think he's one of those guys that knows whether it can be broken or not. And I like having him there. What say you?
I agree. We're very fortunate to have him in that position because he understands liquidity, he understands markets, he understands economic cycles. And on that day, I believe it was a Monday morning, when it looked like the bond market was going to break something, miraculously, we had a 90-day extension in regards to delay on these tariffs. And for us, as you know, we were very defensive. We raised a lot of cash in the beginning of March. And then when Scott Bessent became the face of trade to us, we looked at that as extremely bullish from a market perspective because we felt like he was going to take a stance on trade that was going to be more favorable to the markets. Yep. Because he understands how they work. And we started buying dips during that time period because of that. So to me, one of the biggest risks would be, God forbid, he leaves or he becomes not the face of trade. And if that happens, we will have some serious problems. So I hope that doesn't happen.
All right. So you mentioned the gold. I mean, we've seen gold routinely up $50, down $50. What are your thoughts?
It's trading like a tech stock these days. It's supposed to be a defensive position.
Right.
We started buying gold last year as a replacement for some of our defensive positions like we would have government bonds, because bonds have been one of the worst places to be. So we initially did that as a defensive play, not thinking it was going to outperform the S&P last year. And my gosh, the performance this year is even bigger. So we've grossed up our position and bought dips in gold. And now between gold and gold miners, we have about a 20% position there. I think one of the biggest reasons why gold is going to continue to do well is, number one, it's very under-owned. And I think you're going to see more and more people adopt that same theory of, okay, maybe some types of bonds are not going to do well in this higher for longer interest rate market environment, but don't want to put it in stock. So maybe gold is a defensive position to flow assets into. And then I think you're going to continue to have volatility in the dollar as trade continues to be uncertain. And so I think this gold bull run is going to continue to go for the next few months and will continue at least until, at a minimum, we have a deal that the market likes with China. And that's going to be a while.
Yeah, that's the big one. I would be remiss, but what are your thoughts on the Fed and rates? Where do you stand there?
I think they made a huge mistake by cutting last year.
Agreed.
I think there's a case to be made with some of the things happening with the slowdown that's happening economically, that if we had those 75 basis points back, they would have been able to cut But because they cut last year and used up the ammunition, they have put themselves in a spot where they can't cut even if we need it right now. They're going to wait until it's too late to cut is what my biggest fear is. Because if they were to cut now after cutting 75 basis points, a 10-year bond would probably run up and head back towards 5%, and that's going to be a big problem. So they put us in a bad spot by making a mistake last year, in my opinion.
And I think it kind of smells. I tried to allude to it a little bit in my monologue, but, when you're cutting rates at all-time record highs and you don't want to budge when you see the volatility and the 14% swoon that we just saw, it just doesn't smell right to me, especially when you throw an election in there November 5th.
And the other thing, too, is they keep holding their hat on this 2% inflation number. We're not going to get there. The only way we're going to get to 2% is if they crash the economy.
Right.
So they need to pivot and focus more on labor and rate of change of economic growth on their monetary policy side.
For a long time, probably a couple years now, I've been saying that they should probably move that number up. If they move that number up and gave the go, said maybe let's go to 3% or 3.5% even, I think that would be good for stocks. What do you think?
I do. I mean, I agree completely with you there. I think if they move the needle to 3%, they can position it in a way that doesn't make them look bad, and the market will love it. And that is going to be the new norm. We are not going back to pre-COVID inflation levels unless something really bad happens. And we don't want that case. We don't want it to go down for the wrong reasons.
Yeah, because I think that would give them a lot more leeway, a little bit more room. It's a little bit more realistic, too. And again, like you said, I mean, I think we had somebody on that. I think it was Nancy Tengler who's going to be on next. She said that 2% target came from some central banker in New Zealand about 70 something, and nobody knows where it's like the 6-foot rule during COVID. Who made that up too? Nobody can find an answer to that. So that arbitrary number has been really a thorn in our side. 10 seconds to you before we go.
I agree. They need to be forward-looking in their data when they make decisions and stop looking at old data in the rearview mirror, because that doesn't do any good. We don't do that for clients, and they shouldn't do that in their Fed policy.
And we don't do that when we drive either, right? I mean, that'd be impossible.
That's right.
All right, man. Thanks for coming on. Eddie Ghabour, thanks for coming to us.
Thank you.
From Delaware there. All right.